Hey there, it's Dustin Miller in Victoria, BC, and today I'm going to be talking about stochastic oscillators as an indicator for Forex trading. So there's three different types of stochastic oscillators: the fast stochastic, the slow stochastic, and the full stochastic. All of them operate in a similar manner. However, most traders refer to stochastic. They're talking about the slow stochastic. So that's going to be the focus of what I'm talking about today. So the basic premise of the stochastic is that prices close in the upper end of the trading range when they're in an upward trend, and they close in the lower end of the range when the financial instrument you're analyzing is in a downward trend. So the stochastic contains two lines, the percent known as the percent K line and the percent D line. I'm not going to go into the full formulas for each because most charting packages will calculate these for you. However, you should know that these are momentum oscillators, so the percent K line is rising. That is an indication of momentum is increasing in the market, and when the percent K line is falling, it's an indication that momentum in the market is decreasing. The percent D line is just a simple moving average, 5 periods, and it acts to smooth out the price action of the percent K line indicator and slow it down a little bit. And it also acts as a signal line for the faster percent K line. So this is a banded oscillator, just like an RSI. It fluctuates between 0 and 100, and the range is marked by a line at 80, and the lower end of the range is marked at 20. So see here, you have an overbought area, and you have a break below the 80 line, and then we have a sell-off that results because of that. And then you see the oversold area here. We have a break above the 20 line, and then we see a rally here. Again, hindsight is not 20/20, so there is going to be a few false signals with this indicator, as with any indicator. One of the ways to reduce the amount of false signals that you're going to get is by combining indicators and combining methods of analysis using some of the things that you can learn through these tools. So here the indicator was an overbought area and dipped below the 80 line, but did not have a sell-off after that. But hopefully, if you would have been been using trends and some Dow theory, you would have seen this strong uptrend here, and you would not have taken into a sell trade into the downside because there wasn't a break in the trend line. Here, however, there was a break in the trend line, and we have not only a break in the trend line, which is a very strong signal, but also a break back below the 80 line. And we did see a sell-off. A second way this can be traded is with crossover signals. So the percent K line is the fast line, the percent D line is the slower line. So when the percent K line crosses above the percent D line, this is an indication that it may be a good place to buy. And when the percent K line falls below the percent D line, it's an indication that it could be a good place to sell. This is basically a way for aggressive traders to catch earlier signals, particularly from overbought and oversold areas. So you can see here we got a bearish cross from our overbought area, and the bearish cross with the percent D line trading above the percent K line, and we got the break below the 80 band. You could have got in, however, earlier into the trade, the overbought area, instead of waiting for the break. So the divergence is a third way of using this oscillator. It's very simply when the market is making new highs and when the market's trading in the opposite direction of the indicator, is an indication that a reversal may be coming. Here we have a divergence. You can see that the market's making new highs. which you can see by looking at the stochastic that momentum in the market is not following. So you may have noticed that the stochastic is really similar to an RSI, which is true, and many traders use one or the other or both. And it could be used in conjunction with the RSI to confirm each other and to confirm opinions on momentum in the market.